Hello everyone, welcome back to our Forex training series. I'm really glad to see you once again. Before we begin, please don't forget to subscribe to the channel, hit the like button, and turn on the notification bell so you never miss any of our free lessons. And remember, this series is completely for beginners. You don't need any previous knowledge of Forex. We're building from the ground up together. In our last lesson, Module 6, we talked about risk and money management. We learned that discipline is the foundation of trading. We saw why protecting your capital is more important than chasing big wins. We talked about setting realistic profit targets. And we learned how to control greed and fear in trading. That lesson was all about protecting your account and thinking like a professional trader. Now, in Module 7, we're diving deeper into the mind of a trader, trading psychology. This is where we deal with the emotional side of trading. Module 7, Trading Psychology. 1. Understanding emotions in trading. Trading is emotional. Every time you put money into the market, you're dealing with fear and greed. Fear makes you exit too early or avoid taking good trades. Greed makes you overtrade or risk too much trying to get rich quick. Example, you enter a trade, it's in profit by $15, but you're afraid it might reverse, so you close it early. Then, you watch the price go another $100 in your favor. That's fear controlling you. 2. The dangers of overtrading. Overtrading means opening too many trades, either because of excitement, greed, or trying to recover from losses. The problem is, the more you trade without discipline, the more mistakes you make. Example, a trader loses $20 on a trade and immediately opens 3 more trades to make it back. Instead, they lose $60 more. This is called revenge trading. 3. Developing patience. In trading, patience is your best friend. Not every minute is a trading opportunity. Sometimes the best trade is no trade at all. Example, you see the market moving sideways with no clear direction. An impatient trader jumps in randomly and loses money. A patient trader waits for a clear breakout or a strong trend before entering. 4. Building confidence without overconfidence. Confidence comes from practice and sticking to your plan. But be careful, too much confidence leads to recklessness. Example, after 5 winning trades in a row, a trader thinks they can't lose. They double their risk size on the next trade and lose it all. The goal is to stay confident in your system, but humble enough to follow your rules every single time. 5. Creating a trading routine. To manage emotions, you need structure. A trading routine helps you stay calm and consistent. A good routine can include checking the economic calendar for news, reviewing charts for setups, setting your risk before entering a trade, writing down results in your trading journal. Example, imagine you only trade the London session. You start at 8 a.m., review charts, wait for your setups, and stop trading by noon. That routine keeps you from over-trading or trading when you're tired. Fantastic work today. In this class, we cover the essentials of trading psychology, how emotions affect trading decisions, the dangers of over-trading and revenge trading, why patience is key to success, how to build confidence without becoming reckless, and the importance of having a trading routine. If you master your mind, you master the market. If you enjoyed this class, please like this video, share with your friends, and subscribe to the channel so you can keep learning Forex for absolutely free. In the next class, Module 8, we'll talk about trading plans and journals. This is where we'll take everything you've learned so far and put it into a structured plan you can actually follow. See you in the next class.